No amount of delusion will ever beat the basics of economics. UPS has proven that. Hi, I'm Ivory Hecker for Noble Gold News, and let's talk about the poster child for employee rights, UPS, and how it did the exact opposite this year. They became the ultimate proof on how the economy really works. Last year, UPS was seen as the ideal employer when it announced a record-breaking union deal, giving part-time workers no less than $21 an hour, up from a minimum of $15.50 an hour. Full-time workers will average $49 an hour. Current workers will get $275 more an hour this year and then $750 an hour more over the 5-year contract. Media sang praises, explaining this is proof eternal that the business can afford to give employees higher salaries. And now UPS is firing 12,000 employees, citing a forecast for weaker shipping demand in 2024. The company said the downsizing will save about $1 billion in employee costs. According to a report published by Yahoo Finance, the mass layoffs will primarily target management level and contractor positions. They come after the shipping giant reported a 9% decline in revenue to $91 billion, down from $100 billion. Make no mistake, that lucrative union deal is great if you still have a job. The truth is that minimum wage is a myth. Minimum wage laws and union agreements are often celebrated in political circles, portrayed as the result of kind-hearted politicians and union leaders pushing to increase wages for workers at companies seen as stingy, like UPS. This narrative paints a picture of triumph for the average worker. However, the belief that minimum wage laws and union agreements purely benefit workers without any adverse effects is deeply flawed economics misconception. To illustrate the point, imagine if a minimum wage was set at $1,000 per hour. It's clear this would be impractical and cause numerous issues, as no employer could sustain such wages. The recent union agreement at UPS serves as an example, effectively setting a new minimum wage for its unionized workers and reducing the company's operational flexibility. This agreement was not willingly embraced by UPS based on economic considerations alone. Rather, it was a result of pressure amidst concerns that labor disputes could drive customers to competitors like FedEx, as reported by Yahoo Finance. A wage fundamentally reflects the cost of labor governed by supply and demand. Increasing the cost of labor typically leads to a decrease in demand, meaning fewer jobs. While governments and unions can mandate certain wages, they cannot compel companies to hire. At UPS, the union agreement has forced the company to create more unionized positions, putting it in a difficult position amidst falling business, unable to reduce its workforce due to union protections. As a result, to manage declining revenues, the company has made cuts elsewhere, affecting non-union members and contractors. Further, the increase in salary gets paid by the end consumer. The consumer will either go to competition or demand their own salary increase as goods and services become more expensive. That puts us back into the cycle. This situation may not concern union leaders or securely employed UPS drivers, but it's a significant issue for the 12,000 individuals facing unemployment who also have families to support. This scenario underscores a key economic principle. The laws of economics cannot be overridden by government or union decree. Economic actions always involve trade-offs, reflecting the reality of scarce resources. When benefits are allocated to one group, there are invariably costs to another. In the case of UPS, allocating more resources to drivers meant fewer resources available for other employees, leading to cost-cutting measures elsewhere. As the French economist Frédéric Bastiat pointed out, it's crucial to consider both the immediate benefits of a policy, like pay raises for union workers, and its indirect, possibly negative consequences, such as job losses. Unfortunately, many policymakers, union leaders, and general public fail to appreciate these broader economic implications. This is why you need to invest in a global asset. Unless this government starts dealing with the basics of economics instead of playing politics to make themselves look good, our economy will continue to deteriorate. Unfortunately, the ones who will suffer in the end is us. We get more money, but it's losing its value. We need to protect our savings, especially if we are already thinking about retirement, no matter how many decades away we are from it. Hedge, 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 and gold is the best asset for it. Did you know that had you kept $1 million in cash 20 years ago, it would only be half as powerful now? A little over $570,000 is what it would be worth now. If you invested $1 million in gold 20 years ago, you'd be sitting on $6.6 million now. That's the best way to understand how gold hedges against economic distress. Gold freezes the value of your money. Gold cannot be overprinted, overmanufactured, or overproduced. Nothing on this planet can produce gold. It takes a literal astronomical event for gold to form. That is why you can't inflate the value of gold. The world has what it has. Unless a meteor containing vast amounts of gold lands on Earth, we cannot have more. Couple this with the increasing demand, not just investment, but also for industrial uses, and you will have the exact opposite of what's happening with our currency. Just call 877-646-5347. That's 877-646-5347. Or you can also go to noblegoldinvestments.com. That's noblegoldinvestments.com.